For the annual exclusion, the IRS cares about one big idea: present interest versus future interest. A present interest gift means the person can use, possess, or enjoy the property right now with no waiting period. A future interest means their enjoyment starts later. On the EA exam, if you see trust later or after a condition, your annual exclusion radar should go off. Here's the trap. Future interest gifts do not qualify for the annual exclusion. Even if the gift is real and irrevocable, if the beneficiary can't benefit yet, you don't get the annual exclusion. A common pattern is a trust where income is used for something first, like paying a mortgage, and only later flows to the beneficiary. That later makes it a future interest. Example: Shepard transfers a rented office building into an irrevocable trust for Bethany. The trust says rent must pay off the mortgage first. Only after the mortgage is paid does Bethany receive net rental income. Bethany's right to income is postponed, so this is a future interest gift. Result: no annual exclusion for that transfer, even though the property is already producing rent. Now, gift splitting. Normally, each spouse has their own annual exclusion and basic exclusion, and each spouse files Form 709 if they made reportable gifts. Gift splitting is an election that treats a gift made by one spouse as if half came from each spouse. On the EA exam, the big trigger is both spouses must consent, and a gift tax return is required to make the election. Quick example: Jerry gives his friend $28,000 and Ella gives her niece $31,000. If they elect gift splitting, each gift is treated as half from each spouse. That can keep each spouse's share at or under the annual exclusion per donee, avoiding a taxable gift. But you still file Form 709 to elect splitting. A sneaky exam twist: if they instead write separate checks as separate gifts, they may avoid needing a return at all. Community property adds another twist. If spouses make a gift from community property funds, the IRS generally treats it as made 50% by each spouse automatically. So you may already have a split without making a special election. On exam questions, always ask, was the gift from separate property or community property? That changes whose gift it is and who may need to file. Last bucket: non-taxable and non-reportable transfers. These are gifts you generally don't report and don't pay gift tax on. Think, under the annual exclusion, unlimited gifts to a U.S. citizen spouse, gifts to charity, gifts to political organizations, and direct payments of tuition or medical expenses to the institution. Also, a parent supporting a minor child can be non-reportable when it's a legal obligation type of support. Two fast examples. If grandpa pays a college $42,000 for tuition and pays the hospital $29,900 for surgery, and he pays the institutions directly, those transfers are not reportable gifts. But if Andrew gives his nephew $39,000 in cash to start a business, that's a reportable gift because it exceeds the annual exclusion and isn't a special category like direct tuition or medical. According to the IRS, which factor does not weigh in favor of the IRS approving equitable relief? The choices include abuse by the spouse or former spouse, poor mental or physical health when signing the return or requesting relief, the taxpayer still living with their spouse, or none of the above. Think about which one is actually an unfavorable factor. The correct answer is the taxpayer still living with his or her spouse. Living together is generally an unfavorable factor for equitable relief, so it does not weigh in favor of approval. A tempting wrong answer is poor health because it sounds negative, but for equitable relief, it can support the taxpayer's request. Diana is 80, a wealthy widow with a traditional IRA and an RMD due this year. She makes a tax-free gift directly from her IRA to her church as a qualified charitable distribution. Her AGI is $80,000. What is the maximum amount she can withdraw tax-free as a QCD? 0, 40,000, 100,000, or 80,000? Think about the annual QCD cap. The correct answer is $100,000. A qualified charitable distribution from a traditional IRA to a qualified charity can be excluded from income up to $100,000 per year, and it can also count toward the RMD if done by the deadline. The $80,000 option is tempting because it matches AGI, but AGI doesn't set the QCD limit.